current market conditions. Again, we had pretty volatile day. Volatility is here to stay. VIX dropped to 15, jumped back to 18, 20. Let's go back. Intraday, 1 day, intraday, let's do 5 days. So again, pre-market futures, China mentioned that there will be additional tariffs imposed on US imports, automakers, chips, agricultural products. So the market sold off, retested 2900 level. 2900 level has been a pretty good support for the past, let's go back 10 days maybe. Right, so we've been at 2900 since August 18, so that has been a pretty good support for the market, around 2893 to 2900. We retested the 2900 in the morning, and then when Jerome Powell started speaking about 40 minutes ago, then the Treasury yield went up, Treasury prices went down, and market, I don't know, recovered maybe half of its losses. So 2900 has been a strong support. Bulls want to see that support. 2942, 2950 has been. Let me settings. So the bulls want the market to hold down to 2898 level. 50-day moving average is right at the 2935, 2950. So that's a strong overhead resistance, which market was not able to break since, let's go back further. Let's go back 30 days, 1 month. All right, so we haven't been able to break 2950 since FOMC decision in August, right? That's been the overhead resistance, 2950. 2900 been a support since August 18. You always want to look not only at Fibonacci retracement in terms of support and resistance levels, but also time series, right? The longer bulls are able to hold on, the harder for the bears to break 2900 level. And the reverse is also true. The longer the bulls are unable to break 2950, the harder the bulls have to fight to break through this 2900. So we've been trading in a narrow range since August 18. Before that, if we are unable to hold on to this level, if the bulls are unable to hold on to the level, then the next level of support is 2820. We briefly touched 2775 on August 6th, but for the most part, bulls are able to hold on to 2820 level. So those are your key support and resistance levels on the S&P, whether it's SPX or SPY or S&P futures, the same value. The only difference about the futures is that SPY does not show overnight activity. European session, Asian session, Australian session. So you don't see a print of 2774. So sometimes it's useful to look at the futures contracts to see what the extremes levels were reached. Let's go back to daily trading. All right, so we're trading right below 50-day moving average. That's bearish for the bulls, right? Bulls are kind of trading in a range, but they're losing to bears, right? So at this point, my strategy is every time we reach 2950 or near that level, I would go short. Every time we reach 2800, 2820, I would go long, because we're trading in this consolidation phase, and it might be over, in the next couple of weeks. I think a lot of volatility will be here the next 2 weeks after the Labor Day. We will see if China will impose tariffs on the United States. Will United States impose tariffs on China? Will United States impose tariffs on France, on French wine? Will Britain exit European Union without or with the deal? So there's still uncertainty remains, and usually market does not like uncertainty. So until there's empirical data that shows bulls are in control and they're above 2950 level, or bears are in control and we are below 2770, 2730 level, then I will assume that we're trading in consolidation phase in this box or rectangle, however you want to call this consolidation phase. Let's look at Russell 2000, other indexes, see if there's anything. All markets back in positive territory. Great. Thank you, Osama, for sharing that. That's good for the bulls. Russell 2000, slightly down today, trading between 50-day moving average, 200-day moving average, lower Bollinger Band, key support 145 level. We briefly breached that in August, right? This is going back to May low. So small cap Russell 200 Russell 2000 stocks are underperforming the market. That's not good for the bulls. Usually we want to see small cap stocks leading the market. Gold, I would keep looking at the gold. Gold is up 1%. That's probably bearish for the bulls. So still a lot of uncertainty. People are hedging. We are at multi-year high on gold. Treasury is another very good indicators of where the market is heading. Treasury prices are higher as of right now by 0.5%. Again, at multi-year high. So that's also bearish for the bulls. You want the gold to sell off and treasury prices to sell off for the bulls to regain the upper hand and break through the 50-day moving average. DXY US dollar index is another key indicator to show how the global economy is doing. US dollars has been flat, close to 52-week high. This is also bearish for large industrial companies. This is bearish for China, emerging market, bearish for currencies, and puts probably overhead resistance for the market to continue going higher. Strong US dollar. Let's see, what is leading the market? Utilities continue to lead the market. Typical indicator of the late stage of the bull market. We're all-time high at utilities. We are at all-time high at the consumer staples. So utilities, consumer staples, financial REITs, real estate REITs are indicators that we're in the late stage of a bull market, not a recession, not a bear market, but consolidation phase. I think 5–10% correction is healthy for the current market. And as long as, and I think utilities, consumer staples, financial REITs, this is what's holding S&P above 200-day moving average. If we start seeing selling off in financial REITs, utilities, and consumer staples, then that could be a leading indicator that S&P potentially will not hold the 200-day moving average. Until then I think we will assume that the market trades between 200-day moving average and 50-day moving average. Let's see, anything else worth mentioning? Biotech. Underperforming the market, staying at March low, right? January low, February low. So biotech has been underperforming. Alternative harvest has been underperforming the market. These are not signs of bullish market, right? So we are back to January low in alternative harvest, small cap biotech stocks, small cap stocks. Consumer discretionary, so strong retail. We had an announcement this week from Walmart, Lowe's, Target, all up 20–30%. So consumer discretionary is doing well. At least some of the retail stocks like Target, Walmart, McDonald's, Lowe's, and Home Depot. So, but still consumer discretionary below the 50-day moving average, trading at 118. So consumer staples, some of the retail announcements this week are bright spots in the market. Energy is underperforming the market. XLE and consumer and the oil drillers are down. close to the December low. So again, a lot of industries and a lot of asset classes are sitting at key support, whether it's 200-day moving average, whether it's 50-day moving average, whether it's all-time high. So at some point, based on the news, we will break out of this consolidation phase. I personally think that we're going to follow the seasonal chart. This is my key indicator for long-term predictions. It analyzes 25 years worth of data. Stock forecast toolbox, something very important to understand, that stock forecast toolbox or futures forecast toolbox, when we make these predictions for today, you know, market predicted 292 support, 297 overhead resistance. You know, we're at 292. We're as low as 290. This analyzes the past, you know, few months. So there, just like exponential moving average, it gives more. The model gives more weight to the most recent data. It makes prediction for the next 10 days, and right now the market, you know, basically shows positive momentum. August 23rd. Let's see if this is correct. Yeah, so model basically sees that, you know, we will, the 290 level, we will hold 290 level, and that potentially in the next 10 days break out of the session, right? One possible scenario, bulls have been in control for the past week, right? This is the first week we're up, and potentially if the tariffs are not being imposed on September 1st, then market can retest 300 level, right? That's a plausible scenario. Model basically sees the bulls are in control. They're knocking on the doors of 50-day moving average. Assuming there's no negative news, then that wall will probably not hold. And, you know, I'm using the analogy from the, what does it show? Games of Thrones, right? Games of Thrones, we're fighting for the castle, bulls versus bear. And, you know, bulls are knocking on the doors of bears, right? The North is fighting the South, and the bulls are knocking on the doors, and the wall might break, right? That's what the model says. Long-term, similar picture. Model shows that into the next 50 days, analyzing 25 years worth of data, basically it sees that correlation is 60% to the historical moves. Yes, August is volatile. August usually a down month, and that's what we see this month. So we're following the historical moves. Expect September and October also being volatile. We might have an up day, down day, potentially retesting August lows, right? That's what September month shows. But then starting October, end of October, end of November, classical end of the year rally. I think this pattern will repeat itself, assuming there's no escalation in tariffs, assuming, you know, Britain will not exit without the European Union. Some of these events can obviously alter the picture, but purely based on the technical perspective, that's what the model sees the future. How do you trade in this environment?